So let me thank everyone for joining. While Elena reconnects, I think I will just give a bit of additional background. So we're really glad to have you all with us today for this online debate. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance here at the UI. It's a real pleasure for me to welcome you today to the debate that we're arranging on ECB policies in COVID-19 times. I'm really very glad to welcome our lead speaker of today, Isabel Schnabel, member of the executive board of the European Central Bank, as well as our two commentators of today, Jean-Pierre Mustier, president of the European Banking Federation and CEO of Unicredit, and Patrick Honohan, senior non-resident fellow at the Peterson Institute for International Economics. So in her introductory remarks, Ms. Schnabel will review the ECB's policy response to the COVID-19 pandemic, explaining the economic rationale for the ECB's crisis-related monetary policy measures. I will not go in further details, of course, but just to say that the way our discussion will be structured is that for about 15 minutes, Isabel Schnabel will provide us further perspective on the topic. And then after that, we'll open also for remarks from Jean-Pierre Mustier on the one hand and Patrick Honohan on the other. So I think without further ado, I would suggest we get started. Elena will reconnect through a different device, as I can see, and I will hand over immediately to Isabel Schnabel. The floor is yours.
First of all, I would like to thank the organizers for having me in this webinar. It's a great pleasure to be able to tell you a bit about our policy response to the COVID-19 crisis. And actually, I will want to take a more medium-term perspective in my remarks. So as you know, over the past weeks, the hopes for a short duration of the pandemic and a quick rebound in economic activity have started to fade. So the evidence is increasingly pointing towards a more protracted impact of the crisis. And for central banks, this implies a shift in focus from, let's say, economic firefighting to dealing with the implications of the crisis on medium-term inflation. And so today I want to start by talking a bit about the medium-term impact of the crisis, and then in the second part I will explain why the Pandemic Emergency Purchase Program, or in short PEPP, remains the appropriate tool to address the current challenges. So let me start with the medium-term economic consequences. So the immediate economic fallout from the pandemic has been substantial. So in the first quarter of 2020, euro area GDP has declined by 3.6%, and in the baseline scenario of the Eurosystem June staff projections, the output declines by a staggering 13% quarter on quarter in the second quarter. And so now, as the lockdown measures are being eased across the euro area countries, we can see a cautious recovery in activity, but the protracted effects are clearly visible in our staff projections, as you can see on the left-hand chart of this slide. So in none of our three scenarios, the level of real GDP will have fully recovered towards the path that we projected in March by the end of 2022. And in effect, it's very likely that the economy will experience important structural shifts. Of course, disentangling the effects of these structural shifts on demand and supply, and hence also on medium-term inflation, is very difficult. And as you can see on the right-hand side of this slide, in the baseline scenario, inflation is not anticipated to be back on its pre-COVID-19 path by 2022. However, I should stress that the uncertainty around these forecasts is exceptionally large. So while we all know that measuring economic lag is already a challenge in normal times, this is currently even much more difficult due to the highly uncertain effects of the crisis on potential output, both in the short and in the medium to long run. So in the short run, potential output is severely affected by the disruptions in global value chains and by the social distancing measures which constrain the full use of capital. Such effects may partly offset the negative effects of weakening demand on inflation, even in the short run. In the medium to long run, the impact of the crisis on potential output and hence also on inflation will crucially depend on the response of firms and of policymakers to the challenges that we are currently facing. So the households hit by job losses, for example, could be scarred in terms of income and human capital. So the temporary layoffs and the government-funded short-time work schemes have so far successfully cushioned the impact of the crisis on euro area employment. And in fact, as you can see on this slide, the unemployment rate across the largest euro area countries would have been much higher in the absence of such programs. But although the furlough schemes can mitigate hysteresis effects in labor markets by reducing worker displacement, they may also delay the necessary structural adjustments to the crisis. And in addition, there's also a risk of increasing heterogeneity in the euro area, higher concentration in markets, a surge in protectionism, and a rise in the share of banks' non-performing loans. How big these effects actually are will critically depend on the extent to which firms and policymakers will use this crisis as an opportunity to overcome weak potential output growth. And the European Recovery Fund proposal, in my view, is a promising step in the right direction. By strengthening investment in new and sustainable technologies, the euro area can accelerate its transition towards a more digitalized and low-carbon economy. So let me now come to the medium-term implications of the crisis for monetary policy. So in times as today, when the prospects for the economy and also for inflation are highly uncertain, central banks essentially have to act as risk managers. So they need to take action before the risks, and in particular the tail risks, materialize in order to shelter the economy from further and deeper harm. And in spite of the receding stress in financial markets, there was actually an unanimous understanding at the June meeting of the ECB's Governing Council that further strong policy support was needed in order to prevent medium-term inflation from moving further away from our inflation aim. So we had to take two broad decisions. So the first is, of course, the appropriate instruments, and the second is the calibration of the instruments, taking into account potential side effects. And these two decisions are interrelated, and instrument effectiveness is highly state and time dependent. So normally, reduction in short-term risk-free rates leads yield-oriented investors to rebalance their portfolios towards riskier assets, so either along the yield curve or across asset classes. Actually, as you can see on my next slide, this channel is especially powerful when rates are negative. So the negative rates set strong incentives for investors to move away from short-term assets so as to ensure non-negative income flows. And market stress considerably weakens this portfolio rebalancing channel. And although the markets have calmed gradually, stress indicators like this KISS indicator remain at an elevated level compared to the pre-crisis period. And in such conditions, two sets of policy measures tend to be most effective. Those that directly affect banks' funding conditions, and those such as asset purchases that alleviate investors' balance sheet constraints. So the bank-based measures reduce the adverse impact of a tightening of market-based funding conditions on the lending to firms and households. And in fact, euro area banks still face considerably higher refinancing costs in markets than before the crisis, both for secured and for unsecured borrowing. Our targeted longer-term refinancing operations, the TLTROs, address this rationale transmission process. So if banks maintain their lending to the real economy over the next year, they can benefit from rates as low as -1%. And given these highly favorable conditions, surveys point to a significant take-up for the TLTRO 3 in the order of 1.4 trillion euros. Asset purchases, on the other hand, increase the risk absorption capacity of market participants at a time when it's most needed and when limits to arbitrage prevent markets from operating efficiently. And moving to my next slide. So what we find in the literature on US data is that the Federal Reserve's large-scale asset purchases during the global financial crisis have had a stronger impact on financial conditions and on the economy than during less stressed periods. And actually, the evidence on the euro area is very similar. So what we see is that that the PEPP announcement, so that the PEPP purchases around the PEPP announcement had an effect that was almost twice as large as the effect of our regular asset purchase program. So this is the left-hand side chart. In the euro area, however, there is a second dimension that is also crucial for the effectiveness of our asset purchases in periods of market stress, which is geographical fragmentation. So in periods of acute market segmentation, asset purchases tend to operate differently. So as this portfolio rebalancing is weakened, their effects become mostly local. So in other words, monetary policy needs to act in a much more targeted and flexible way in order to reduce the risks of fragmentation. And if you look at the right-hand side of this slide, you can see ECB staff estimates showing that the dispersion of the impact of the PEPP on yields across euro area countries was indeed substantial, with the largest negative effect on Italian yields. And so for these reasons, the Governing Council decided last week that the PEPP remains the best and most effective instrument to respond to these unprecedented challenges that the pandemic poses to the euro area economic outlook. So this brings me to the calibration of the PEPP. So let me shift to the next slide. So by removing duration risk from the market, the PEPP reduces the bond free float ratio. So this is the share of bonds that need to be held by private, price-sensitive investors relative to the total bond supply, and this is shown on the left-hand side. So in the absence of our new measure, so this would be the red dashed line, this ratio would have gradually increased on the back of the large coronavirus-induced increase in debt issuance, thereby putting upward pressure on bond yields. And you can see that the PEPP actually reduced this substantially. If you now turn to the right-hand side chart, you can also see that the PEPP has actually shifted the euro area GDP-weighted yield curve downward measurably. And today it is not so far from the level we observed before the outbreak of the crisis. In view of the historically weak inflation outlook and the already accommodative stance, the question, of course, arises whether our actions are sufficient and whether they are proportionate. And in answering this question, the Governing Council assesses whether the benefits of achieving a faster return of inflation to levels closer to 2% outweigh the potentially adverse side effects. So in other words, we assess how long the medium term should be given current circumstances. So this is a question about the speed of our monetary policy action. And at the current juncture, of course, an important element in determining the appropriate length of the medium term is the risk of second-round effects that may entrench expectations of low inflation and that thereby may leave permanent scars on the euro area economy. However, this risk is mitigated by the emerging policy response in the euro area. So for the first time, fiscal and monetary policy are starting to act as true complements, thereby reinforcing each other's effectiveness. Moreover, inflation expectations by households currently signal very limited risks of second round effect, as you can see on my next slide. So actually I cannot see the left graph. I don't know, it somehow disappeared. So if you can see it, so on the left-hand side, you would be able to see that financial markets actually currently price in significant risks of deflation over the short run. So the probability of deflation has risen substantially, whereas you can see on the right-hand side that the households have adjusted their expectations very differently. So the share of people that expect inflation to increase more rapidly over the course of next year has increased markedly in April, and in May it's still accounted for 32%. So given the already highly accommodative monetary policy stance, the growing complementarity between fiscal and monetary policy, and the high uncertainty regarding the second round effects, our decision appears to be an appropriate and proportional course of action. So this now brings me to the operationalization of the PEPP. So in order to enhance the effectiveness of our asset purchases, the PEPP has to be operationalized in a way that it means the dual objective of countering fragmentation in the euro area on the one hand, and closing the medium-term inflation gap that has emerged from the COVID-19 pandemic on the other hand. So you should not think of the PEPP as an interventionist program where we are standing on the sidelines when the conditions are calm and enter the market only in times of market disturbances. But the PEPP rather resembles a two-staged pyramid. So at the basis of this pyramid there is this constant flow of purchases that reaches out to all eligible market segments. And in the sovereign space, these purchases are guided by the ECB's capital key. So this is the stance element of the PEPP, and it seeks to create financial conditions that are consistent with our inflation aim. The upper part of the PEPP pyramid is its flexibility. So it responds to the challenges posed by the pandemic to market functioning and to the smooth transmission of our policy to all parts of the euro area. And the first granular breakdown of our PEPP purchases, which many of you have probably seen, that was published last week, highlights this particular aspect of our reaction function. In particular, it stresses the three dimensions of flexibility in the PEPP. So first, in the sovereign space, the monthly purchases in all jurisdictions will exceed this basis flow if we observe a general tightening of financial conditions across countries, an unusually high volatility, or poor liquidity. So this determines the front loading of the purchases. Second, we raise the share of purchases above the capital key in countries facing severe risks of fragmentation. And third, the allocation of our purchases across market segments is also state contingent. So for example, we've seen that there was an unprecedented need for short-term liquidity by firms as the lockdown measures dried up their revenue streams. And the firms started to heavily draw down bank credit lines. At the same time, the traditional investors, such as the money market funds, shifted their asset allocation to the shortest maturities only. And in response to these developments, we shifted a significant share of our purchases to the commercial paper market and to the longer tenors in particular. And this is what you can see on my next slide. So today, as you can see on the left, the commercial paper rates for non-financial firms have started to stabilize. And the issuance at the longer tenors is rising, as shown on the right-hand side, thereby reducing rollover risks and hence the uncertainty for firms. So let me come to the end. So COVID-19 constitutes an unprecedented shock to the global and euro area economy. And in this highly uncertain environment, monetary policy needs to play a proactive stabilizing role. So it needs to restore and preserve financial conditions that are consistent with the return of inflation to levels closer to 2% over the medium term. And the Governing Council's decisions of last week were based on the assessment that in this current fragile market environment, the PEPP remains the most effective instrument to respond to the dual risks of a shortfall of inflation from our medium-term aim and of fragmentation in the euro area. So the PEPP's anatomy provides the flexibility across time, across jurisdictions, and across market segments that is needed to effectively counter the specific challenges posed by the pandemic. And it is this flexibility which is the key element of the PEPP, and this will be maintained throughout its lifetime. And this is where I want to end. Thank you very much.
Thank you very much, Isabel. Sorry for my operational risk at the beginning. I hope this time you can hear me properly. Thank you very much. You touched upon a lot of issues that I'm sure we will go back to during the discussion. I see already lots of questions coming. But before we go to the Q&A, let me give now the floor to Jean-Pierre for his intervention. Please.
Thank you very much, Elena, and good afternoon to everybody. Thank you very much for your invitation. First of all, let me congratulate Isabel and actually all the leadership of the ECB, both on the monetary side and on the supervision side, for their very decisive actions, which are not short of being extraordinary and extremely effective. As far as the monetary side is concerned, clearly the two guiding principles used by the ECB, the pledge to prevent monetary tightening as a result of the vast increase of issuance, and the emphasis of on all jurisdictions of the ECB are absolutely right, and they represent a real step forward. And I think the coordination as well with the supervisory side, which has been extremely proactive and very fast to loosen and adjust some of the rules, is outstanding. Clearly, the instruments used are the right one. The various TLTROs adjustments and the tiering linked to interest rate have been very supportive of lending. And clearly the quantitative easing, and particularly the PEPP with its flexibility versus the capital keys, are very good and have been critical to anchor the sovereign curve. It might not be enough, we feel, and I quote my chief economist, being on my side only a very modest commercial banker, that the ECB forecast might still be too modest. We have, as far as Unicredit is concerned, a minus 13% GDP impact for Europe in 2020 and a rebound of plus 10% next year. And the combination of what the ECB can do more potentially with the government fiscal stimulus could be right, but the government will add additional fiscal stimulus and hence additional issuance. Germany came this week. France will add shortly as well. And so, the risks to the markets, have declined but are not completely gone. We might have a relapse. The economy might actually perform less than what could be expected. So, there could be some ideas for the future, which could include adjustment to the TLTRO. They are already very flexible, but we could add longer maturity and maybe further tiering. There could be buying a broader segment of asset, money market set, bank bonds. I think we had discussion with the ECB on buying bank liability, which will have a direct impact on funding cost and hence of lending to the economy, which could make sense. And we could as well ask the government, as the head of the BIS, Augustin Carsten, suggested in his last mile ID, ask the government to add to the guarantee guarantees for receivable financing, which could the bank can finance afterwards, which could help for the working capital issue, which is critical for SMEs specifically. And Augustin was speaking as well about potentially monetizing future tax liabilities for companies which paid tax last year, so which means companies which are in good shape, which can be another idea, and that banks can finance as well. So there is no limit to creativity, but it's fair to say that when the ECB has done an extraordinary job and has done quite a lot, there could be more than adjustment, but flexibility and maybe other ideas. And I would insist, because I'm a banker, on buying bank bonds as well, which would have a direct impact on the funding side. Of course, we need to look as well at what could happen when the crisis stops. One thing which every crisis have in common is that they do stop at one stage, which is good news. And what do we do when and how banks can go out of the TLTRO? Banks need to cannot rely only on the TLTRO for their financing. They need to issue bail-inable securities, specifically the GCP right now, because they are constrained by the TLAC. And while it is too early, but there will need to be a proper visibility on the phasing out of the TLTRO. The TLTRO 3 will be launched very soon. It's very likely that banks will take a very high take-up on the TLTRO, but that represents potentially a big refinancing wall. At Unicredit, we are making sure that we can manage it clearly without relying on future additional actions. But at one stage, and as I said, it's too early, but having a clear visibility on the phasing out of the TLTRO could be a good idea. Then maybe a very quick comment to finish on impact on the policy. As I said, it is very good, but there are some side impact, if I may say. Clearly, on the lending spreads, this amount of liquidity has been tightening lending spread, the government guarantees as well, which impact the bank profitability meaningfully, but could create as well more risk in the balance sheet of banks. We have seen that, for instance, in some of the EBA report. At Unicredit, I was extremely clear to say we don't do carry trade, we don't do volume lending, but there is a risk as well that banks could use this cheap money to buy assets which can create risk in their balance sheet. I refused to do carry trade last year. It was a very good news because with the COVID crisis coming in, having loaded up my balance sheet with credit assets, which might be now of more dubious quality, would not have been good news, basically. So I think clearly there is a right brain, left brain discussion which would take place at the ECB between what the monetary side wants to do, the supervision side wants to do, and actions of the bank beyond the pure lending on their balance sheet and the risk profile they could have. Which leads me to my last point, which is this crisis is a health crisis, not a financial crisis. Banks are here to help. At the same time, banks have, and they have a duty to do that, but they have shareholders. And while the focus is what can banks do to help the economy, we need as well to think about how bank shareholder will react and, potentially look at the level playing field with other jurisdictions, the UK, soon out of Europe, and the US, which are not impacted by negative rates, which have maybe more visibility on dividend payments. So, while we all understand what are the priorities today, the fact that banks need to do the right thing, I think in a second stage, which should come soon, we need as well to give more visibility to investors about what could happen to European banks' profitability. Dividend policy, we fully understand, and there was a recommendation yesterday about potentially, pushing back any dividend payment to next year. It was a recommendation, not yet a decision. If it is the decision taken, we need to give investors the visibility about what could be dividend payment in 2021, otherwise the system might become uninvestable. We need to see as well what is structurally the outlook for European bank profitability, and I would say the viability or ability to fund growth and to fund the economy. Not a priority now, but let's not forget that banks have a duty to finance the economy, but have to create value for their investors. And we need to look as well at what should be the shareholder position in the second stage. Stop here.
Thank you very much, Jean-Pierre. Again, you touch on numerous issues that we will go back in the Q&A, and also we will hear from Isabel's response. Now, Patrick, given that we have been talking about other jurisdictions, so I suppose you are going to give us an idea of other jurisdictions, at least vis-à-vis the central bank.
What else could central banks, what else could the ECB do? The central banks moved quickly at the beginning of this pandemic, market panic. Federal Reserve particularly, ECB also, to deal with the initial shock. Yet we're still in an extraordinary condition. We still, on top of the persistent low inflation, we have this severe broad-based interruption in economic activity, which is likely to be followed by a slow recovery. So I just want to raise a couple of frontier issues in central banking. The ECB can look to other central banks to see what they have done and whether that fits into the needs and potentialities of the ECB. ECB has used many previously unconventional tools. It's a big user of targeted refinancing, which I suppose was initiated by the Bank of England. It's a big user of negative interest rates, which I suppose came from Japan and Switzerland. Big user of QE, as in Japan and the US, including on corporate bonds. But still the toolbox is not empty, and I want to raise three possible areas in which ECB might consider doing something. I'm not sure that these would be the best possible actions, but they're worth considering. The first area is yield curve control. Japan has adopted, in 2016, adopted what's called yield curve control. They said we're not going to let long-term 10-year interest rates in Japanese government bonds yields rise above around zero mark, and they've maintained that since then. They've maintained it without purchasing very many Japanese government bonds. The promise seemed to be enough. Australia is doing the same since March of 2020. It's an interesting idea in the euro area because at the moment there's no problem in certain parts of the euro area with long-term yields, but as the crisis progresses, we can't be sure of that, and very large sums of government bonds are being purchased. You could also help ensure transmission of low long-term yields to all geographies within the euro area, reducing fragmentation by announcing a yield curve control policy. Now, of course, that gives you the challenge: what spreads are the appropriate spreads for peripheral sovereigns? And here there might be a solution. In normal times, it might be quite difficult to establish an appropriate spread, but I think that the fact that we had a period of relatively calm conditions before the sudden pandemic gives you an indication of a sort of market equilibrium, normal time spread. You could lock in a pre-pandemic spread on the peripheral government bond yields. Now, why would you not want to do this? Why would this be a bad idea? I think there are two dimensions. One is an economic dimension, and one is maybe a legal issue. The US, the Federal Reserve, had a yield curve control policy through the 1940s, and the problem arose towards the end. How do you exit a yield control policy when you don't need it anymore? When long-term interest rates, you want to have them higher. Unless you move very quickly, you're going to, at that moment, you may end up with a huge flood of market sales. And that's what the Federal Reserve discovered in 1949-50, and they ended up in March 1951, the Federal Reserve Treasury Accord. They managed to get out of the problem. But there is a problem of exit. So starting this might be a great idea. Ending it might be much more difficult. And there are also possible legal issues, especially the open-ended nature of the purchases. Even if we think there will be fewer purchases, and we appeal to the Japanese experience, we can't be sure and we can't promise. Second issue, climate change. And Isabel has already alluded to it, to the need to move to a low carbon economy. There's the secondary mandate of the ECB to support general economic policies in the Union, and that includes climate change and quality of the environment. With all these bond purchases, including private sector bond purchases, should there be a climate change filter here, or is the ECB working against the drift of the general economic policies in the Union? There's an additional argument for having a climate change filter in your asset purchase program, and that is that widely held view among bank supervisors that ratings, credit rating agencies or ratings mismeasure climate change risk, and the argument is made by the supervisors that an additional penalty should be applied to financial institutions, regulated financial institutions, which are taking on this unmeasured climate change risk. If that's the situation, then that should be applied also to central bank purchases. So if the central banks are saying we're only going to buy investment grade paper, maybe it wouldn't be investment grade if you added a climate change filter. So that's an area definitely worth examination. I think it's part of the ECB's review of monetary policy strategy, a review now which is postponed until mid-2021. It's a pity it wasn't done in peacetime. certainly an area for close consideration. The final area I want to mention, given the limited amount of time, is whether there should be a greater ECB role in addressing the corporate liquidity crunch in the pandemic. Now, it has been involved, particularly with the bond purchases, but this is a very unusual situation for non-financial firms. Cash reserves of companies are generally inadequate to deal with the shutdown. There's been a big drawdown of cash, as mentioned by Isabel. And there are firms with viable post-pandemic business models that could be killed by the shutdown. But too much borrowing during the pandemic could also undermine their balance sheets. Many countries governments have introduced lending and guarantee schemes. And the problem, which is largely unrecognized in these schemes, is that such borrowing might leave even firms with viable post-pandemic business models without a viable balance sheet going into that post-pandemic era. Now, so what's the role for central banks in this? Several countries have engaged their central banks, at least for supporting prices of investment grade or in near investment grade companies. Obviously, for example, the Bank of England, the corporate paper market has been hugely expanded by the Bank of England's willingness to go in and buy corporate paper. The Federal Reserve has several programs, including the purchase of sub-investment grade bonds, and including by purchasing ETFs with such bonds in them. And the Federal Reserve goes even further with what they call the Main Street Lending Program. So this is a program where the Federal Reserve is prepared to take a 95% stake in loans, for example, is even as small as $250,000, going up to $300 million for firms, medium-sized firms with less than 15,000 employees, turnover less than $5 billion. So this is a big involvement of the Federal Reserve in corporate lending. Now, the big feature, of course, of that program and the other programs as well is that these programs have a treasury backstop. They're not, the credit risk is largely absorbed by the US Treasury. And here's where the ECB might have a difficulty. Is the independence of the central bank compatible with such central bank treasury cooperation? Not necessarily. But it is tricky, and it might be argued by many people that the European Investment Bank is a more natural entity for delivering such policies. But I think this should not be a closed matter. It's true that the Fed might be drawn further into quasi-fiscal policy than it expects, as these debts are unwound with debt equity swaps, complicated restructurings, bail-in of existing debts and the like, so that the ECB could get very much sucked into something to do with corporate restructuring that is very far from its main mandate. But these three areas, I think, are worth continued study. Central banks are not out of ideas yet, despite the new and dramatic shock that's been superimposed on the legacy of the GFC with the low nominal interest rate and low inflation.
Thank you very much, Patrick. So, Isabel, maybe before we open up for Q&A, because I see already that there are really many Q&A questions from the audience, maybe let me give the microphone back to you for initial responses to what both Jean-Pierre and Patrick.
Yeah, okay. By the way, I could hear Jean-Pierre very badly, so the volume was very low, so maybe you can adjust your mic, because I could hardly hear you. I don't know whether it was the same for the others. But so thank you very much for this these excellent remarks. So I think both of you are perfectly right. I mean, there is no limit to creativity. I think we have to be open to extensions of our toolbox at any time. So this is an extraordinary crisis. This is obvious, and this extraordinary crisis, of course, requires extraordinary responses. Let me say that I think that actually our toolbox is already quite good. I mean, when we came into the crisis, we had the advantage that many of the instruments were already there and just had to be adjusted. which made it possible that we could implement our instruments relatively quickly. So if you compare, for example, to the Fed, I mean, you see there, of course, they have, I mean, they created many new programs, but it's taken them a long time in order to implement them because a lot of this is new, actually. Let me discuss some of the proposals that were made. So first of all, I would like to say that at the moment we feel quite comfortable that the toolbox that we are using is very effective, that it brings us very far in working towards higher inflation and also to reducing fragmentation. So it's not that we think that at this point in time we necessarily have to expand our toolbox already right now, but of course, depending on how the crisis develops, there may be a time when this becomes necessary. Jean-Pierre mentioned the bank bonds. Of course, this is certainly an interesting proposal. It raises a couple of issues, right? Given that we are also a bank supervisor, this may raise issues of a conflict of interest, and so this is not I would say it's not an easy issue. Regarding the yield curve control, I think that Patrick actually mentioned some of the problems already. I mean, different from, say, Japan, there is not the one yield in the euro area, but we have many different sovereign yields. And actually, one issue that we've been struggling with is that we have observed this disconnect between the risk-free curve and the euro area GDP-weighted curve. And this is exactly why I think the PEPP is so useful, because it actually helps us to deal with exactly that problem. There are clearly, with respect to yield curve control, there are clearly legal issues, and I also agree with Patrick that exit is not trivial. Of course, exit is never trivial. Jean-Pierre also mentioned the exit from the teltros, so I think it's perfectly true that one has to think about the phasing out. Climate change is one of the topics that is very high on our agenda. Patrick already mentioned this is one of the most important topics in the upcoming monetary policy strategy review, which, by the way, is restarting now again. There, of course, at the moment, the private purchases are guided by market neutrality, one has to be aware of the fact that if one departs from that, it's very easy to buy more green bonds, but at some time one also would have to buy fewer green bonds. So then that may be then less popular. I mean, in general, I think one has to go through the risk, as also mentioned by Patrick. So I mean, both on the supervisory side and on the monetary policy side, I think we have to better understand what are the implications of climate change for risk, which may then also affect our asset purchases. I mean, the haircuts and so on in the collateral. We have to be aware of the fact that currently the volume of green bonds, of course, is very small, right? And if you look at our corporate sector purchases, I mean, overall, the volume is still, the eligible universe is actually still quite limited. I mean, given that market-based financing still plays a much smaller role than let's say, in the US, and the green part of that is even much smaller. So if I remember correctly, we are already now holding 20% of the green eligible universe. So it's already quite substantial, actually. Regarding the corporates, there actually we are doing already quite a bit. I mean, The CSPP, the Corporate Sector Purchase Program, has been running for quite some time, many years. We now expanded the corporate purchases by including commercial papers. So in the pandemic, we have bought large amounts of commercial paper. There is, of course, a discussion about the fallen angels, and many are worried about a wave of downgrades coming, which then may have challenges for financial stability. Patrick is perfectly right that the Fed is in a more comfortable situation due to the fiscal backstop, but I also agree with him that one has to be open to discuss what could be done in the euro area. Of course, it raises some issues for independence. Also, I'm not quite sure whether there is a lot of political appetite to go into such a direction. So finally, let me go back to some of Jean-Pierre's comments. So I think that what has been very important in this crisis is that there have been responses from many sides. So from monetary policy, from supervision, and from the fiscal side. I think all of them also help the banks, but of course we are all aware that the risks in the balance sheet may rise, that the non-performing loans are very likely to rise. There is this long-standing issue of bank profitability, which of course, which has been there for quite some time. So there are certainly a number of structural reasons for that. There have been many people proposing that we need more consolidation in the European banking sector, that you need cross-border mergers and so on, moving more towards a complete banking union. All of this, I think, would be crucial in order to improve bank profitability. So maybe I'll stop here. Thank you.
Thank you very much, Isabel. I see that we are already shortly before 2, so let me now go instead to Jean-Pierre. There have been a lot of questions in the Q&A box regarding banks. Let me just address some of them to you. The first one is there has been a proposal to create an asset management company at the European level. So the audience would like to know first, what do you think about it? And second, assuming that this will be created, whether do you think banks will have a stigma problem in using it, so that in any case could be a sign of weakness. The second one is, some people say that banks cannot take advantage of the reduction in capital buffers or in general in the relaxation of supervisory measures, because they may be worried about market reaction and also credit rating agencies. Do you see this as a problem or not? Third, how do you think about the ability of banks to create enough reserves to be able to somehow withstand the possible future credit losses that the crisis may generate, and nevertheless still provide the lending to the economy, given that, as you yourself said, there is an issue of low profitability of banks? And lastly, what about risk-taking of banks? In a sense, shall we worry about the reaction of banks to the presence of state guarantees and other policy support, when we know that in the past, at least, some banks may have exploited this?
Thank you very much, Elena. So, I'll try to cover that in one go. On the asset management company, I think that, first of all, I think it's very difficult to have public money making investments. So my view is that it's probably much better that such an asset management company provides a structuring for smaller banks which have not the structuring capability to sell NPLs. Large banks do have structuring capability and direct interaction with investors, so they don't need to have help for that. But I think if we have state money buying NPL, then you create a market which can be unbiased, what is the true price of NPL, and then you create a problem on the origination side, basically, as it might skew the price of credit. So I think it's a good idea for smaller banks for structuring, but not a good idea if we have a quote-unquote bad bank which buys all NPLs of all European banks. Then you create a massive moral hazard and a skewed on the credit price. On the second point, which is taking advantage of capital buffer, I think that it is very difficult for a bank to let its capital buffer go down. We have moved from absolute capital level towards a capital buffer, let me say, in the past as far as Unicredit is concerned, and I think this move was actually the right one to do with the CRD5 Article 104, which is lowering the MDA. So the absolute capital level today is not so much the reference, but that's the MDA buffer, which is the reference. And we've been on our side very clear about which kind of target we have, which is 200 to 250 basis points. And even in a tense situation, we'll never go below 200 basis points. Luckily, last year we went down to 200 basis points because we had to take impairment on our Turkish bank, which we sold subsequently, as well as because of US sanctions. And we sold a lot of assets to beef it up, and now we are at 350 basis points. But I think that we'll never let my MDA buffer go down below the lower margin for the reason you mentioned, which is on one side rating agencies, on the other side investors. If investors see that we have a low capital level, it will impact our share price meaningfully. So the flexibility given by the regulator in terms of regulatory forbearance might be used by some banks which might go through a difficult situation, but I think that what banks can do is only use what is the regulatory anticipation. CRD5 Article 104 was an anticipation of a future regulatory evolution, but no more than that in order to manage their buffer. To create enough reserve to finance the economy, there I think it's actually an issue of I say what I do and I do what I say. So in other words, let me give you the example of Unicredit. I never said for our first quarter result that we will pay a dividend on the 1st of October 2020 because we had a super strong capital buffer and a super strong balance sheet. We had a super strong balance sheet and a super strong capital buffer, but my intuition was that the regulator, the politicians will not ask the bank, will ask the bank not to pay a dividend. So I'm not promising to my investors to pay a dividend while other banks did. And they probably knew they could not do that, but they were doing that just to spin the market. And I think that, it's important to take a view which is honest with investors and regulators, and also to take the pain first. So, for instance, we took one of the toughest impact on IFRS 9 provision by having a minus 13% GDP for Europe for 2020. Why? Because it's managing a bank is like managing a toothache. Either you keep the toothache for quite a while and then you go to the dentist, it's super painful, but it's super painful while you take the toothache, or you just go to the dentist now, you take the pain first and afterwards you're okay. So I prefer to take all the pain now, all the provision now, to basically front load everything, and then we can show what is the true state of our capital buffer, our ability to lend more, to manage the bank, and that's it. So I think that it is extremely important that in Europe we do what US banks are doing very well, which is clarity on capital structure, clarity on provision. We upfront all the bad news and we move on, which is not yet the case. And I have seen European banks in the first quarter doing exactly the opposite, saying we pay the dividend, there will be very limited impact, etc., which is bad for the sector and hence bad for us. And I think the sector needs to grow up a little bit in Europe and tell the truth to investors rather than selling dreams. On the risk-taking side, it's the final point, which is the wall of liquidity which is offered by the ECB is an open door for volume lending. And we can see a lot of banks trying to lend desperately in order to gain a little bit more NII and for carry trade. I refuse to do that because you load up the balance sheet with the wrong assets and then you're going to have problems in the future. So short term, you have pressure of investors saying, but your NII is not growing as much as your competitors. Yes, but I manage my bank in a very conservative way, and I make sure that my risk profile stays appropriate. So I think here there's a divergence, basically, of, some banks might be willing to, flatter their NII or their trading profit short term at the expense of the medium term. I behave as a long-term value investor, and I want to make sure that on the long term, I don't put the wrong asset in my balance sheet. So, and it is not incompatible with supporting the economy. It's just that you don't want to do the extra liquidity to do things which you wouldn't do for yourself, basically. So there as well, it's a matter of discipline. So a long answer for short questions.
Thank you, Jean-Pierre. Let me go to Patrick. So there are several questions that I will then pose also to Isabel later after your intervention on the relation between fiscal policy and monetary policy. So you said before that the Fed is, for example, supporting the corporate sector much more, but of course the risk is taking, a lot of credit risk is actually on the Treasury shoulder. But in general, even somehow not thinking about that, there are already a lot of measures that have been taken by national countries in Europe, and now we are also probably seeing some more fiscal policy at the European level. So to which extent a monetary policy should take those into account when deciding the action? And the second question, what about sovereign risk growing in particular on banks' balance sheet, despite maybe the intervention of the ECB?
I think that we've seen over the last 10 years the ECB acting when the governments of Europe did not act. And to the extent that the governments are beginning to act a bit more now, I think that does give the ECB a chance not to have to get into territories for which it is not strongly legally mandated and for which it might not have the technical experience. I mean, you raise the question of AMCs with Jean-Pierre, and we've seen AMCs that worked for corporate, real estate and commercial property, but to have an AMC newly set up to manage SME debt that's distressed is not something for which we have an agency with the capacity to do that. Likewise, to the extent that central banks are asked to get involved more directly in lending to firms that there's not a clear picture as to whether they're going to survive or not, central banks aren't equipped with any particular expertise for delivering on that. So I do feel that it is better for governmental institutions to take the lead and for central banks to ensure that liquidity is available. It's the old distinction between liquidity and solvency. Central banks are really not set up to deal with insolvency situations, and that's why the Fed has been given those backstops by the Treasury. There's a risk that people will say, look, the ECB can take the solvency risk. They can take a certain amount of solvency risk, but it's not a good way to run a country. It's not a good way to run the European Union, to brush solvency risks under the carpet of central banking. So I think central banking should have a very cooperative role in these ventures, but not be the primary risk taker in terms of solvency. It should be ensuring that where there, for example, you raise the question of sovereign risk on the central bank's balance sheet. We know the problem of multiple equilibria. If markets don't trust a sovereign, they may push yields so high that the sovereign cannot pay. Central bank can break that multiple equilibrium by ensuring the low equilibrium prevails, and that's a liquidity intervention, not a solvency intervention. Central banks must be active, but they'd be very foolish to take on credit risk, which ultimately will weaken the fiscal position of countries down the road, and they will not be thanked for that. And just if I may make one more point, central banks are independent, of course, but they need to keep public support. They need to convince the general public that they are working in the interest of the general public. And this speaks to what I was talking about the climate change. maybe what central banks could do in purchasing green bonds, or in having negative lists and not buying the bonds of coal companies and oil companies and so forth, it might not be make much of a difference to the financing of those entities, but it might be crucial to maintaining long-term confidence and public support in the institutions.
Isabel, coming back to you, again, I would like to ask a question between this link between fiscal policy and the monetary policy, and some participants were also wondering to which extent your projections that you show us in your intervention actually reflect the fiscal policies of at least the national measures that we have already seen. So how do you think about them incorporating at least in your projection? Second question to you is also, some people ask why the ECB is not buying a non-investment grade, at least a non-investment grade securities that were maybe investment grade before. But given that you have already accepted non-investment grade in the collateral framework, why not directly buying them? And last question, I mean, I understand that probably you of course, you won't be able to answer this question, but some people are wondering whether if these asymmetries will continue, and in particular if there are divergences across countries and yields in particular of sovereign bonds across countries, whether you will think of extending the divergence for the capital key acquisition in the PEPP, and whether this could be a measure that would stay there for a much longer time, or you see constraints in it. Please.
Thank you very much, Elena. So first, on the link of fiscal and monetary policy. So I think this crisis is different, as I also stressed in my speech, in the sense that we're actually seeing that fiscal and monetary policy are acting in a complementary way. And I think that is very important. So, for example, some have suggested that given that there now has been a fiscal action, that monetary policy should be scaled back. So I think that would be a mistake. But rather, I mean, of course, fiscal action has an impact on our policies indirectly by also improving the outlook and so on. But I really don't think we should consider them as substitutes. I really think that would be a mistake. The national fiscal measures are taken into account in our projections. However, the cutoff date was too early to take into account the European Recovery Fund. So the European Recovery Fund is not included in the projections. So on the question why we are not buying non-investment grade bonds, I mean, actually Patrick gave the answer already. This may not be the task of the central bank. I mean, there is, of course, this may be somewhat different when it comes to the fallen angels, and therefore this is something that we are looking into very carefully, even though, as I mentioned before, this is a very difficult discussion. I mean, the collateral framework and the purchases, of course, are very different, right? In the collateral framework, you have haircuts, and the haircut, even if one accepts below investment grade collateral, the haircuts can be adjusted accordingly. And in the collateral, I mean, you always the risk is much smaller than when we are buying assets directly, where we are directly exposed to the risk. And of course, this can also create reputational issues if the ECB then is having high losses on its corporate sector portfolio. So this has to be analyzed very carefully. I mentioned in my speech that the flexibility of the PEPP is crucial in order to deal with all these different types of asymmetries that we're facing in the euro area. And of course, this flexibility also means that we may deviate from capital key. And The way the PEPP is set up is that that the purchases, so this is what it says in the legal act, that the purchases are guided by capital key, which does not mean that that the stocks exactly correspond to the capital key. And this flexibility will be needed throughout the crisis. Of course, in the middle of the crisis, it wouldn't be very wise to return such deviations from capital key. But of course, we have to make sure that overall, over the entire program, including also the reinvestment phase, we are in line with the legal act, which says that we are guided by the capital key.
Okay, I am conscious of the fact that we are running out of time. Maybe just the final word to Jean-Pierre and Patrick. Jean-Pierre, just one question for you. In crisis time, normally banks retrench to national borders. This is typical factor in crisis. Do you think it will be the same, or do you think that this crisis may actually boost instead a more cross-border integration?
I don't think it will boost cross-border integration. I mean, I heard Isabel as well as the ECB calling for more cross-border mergers. I think in time of crisis, you rather make sure that you focus on the transformation of your bank, on managing the risk rather than looking at such issues. So I think if there is a transaction, there might be much more domestic consolidation rather than cross-border. And you have seen, at least in the first phase, with the relaxing of the state-aid rules, that the states have been, to a certain extent, competing between themselves in order to offer more fiscal policies. Germany is the big winner by offering almost 50% of the total size of the fiscal package, followed by France and Italy. So I think everybody behaves very much domestically, and that we should not expect, as far as the banking side is concerned, much cross-border move in the next few years.
Thank you. And the last word to Patrick, as a former member of the Governing Council. What would be your most pressing recommendation?
I think the ECB can play a very important political role in guiding the Eurogroup and guiding the ministers and guiding the Commission. They have a huge capacity in economic research and in understanding and in having the longer term view. And so I think the Governing Council should present a unified front in pushing Europe towards what will be quite a tough period of recovery after this huge shutdown.
Okay, Isabel?
Sorry, did you have a question?
No, I just want to say whether you wanted to respond.
So I'm actually, the connection was broken a bit,
and then
but I think what he said is that we should also bring Europe forward in all the relevant aspects. I mean, banking union, capital markets union, possibly even a fiscal union, and so on. And I mean, of course, as a very convinced European, I wholeheartedly support that. And I mean, we are doing our best.
I would like to join you on this, and let's finish on this positive note. So thank you very much to all the speakers and to all the participants. I'm sorry that there have been so many questions that I couldn't tackle all of them, but we will send all the questions to the speakers. And thanks a lot for being with us today. It was much appreciated. Thank you.